let's say you want to go and buy some investment property, you're all excited to have a big property to depreciate. Well, you still have to qualify for it. And so if you've been doing all your expenses as hard expenses, then your income is quite low. And so the mortgage guy is going to give you a low qualifying income because your income's low. But if you use depreciation on those hard goods, like computers or whatever you're using, then the mortgage guy will add that back in to your qualifying income. So all of a sudden you can buy more house just because you wrote your taxes a different way. And in some cases, the difference could be big enough that once the taxpayer realizes how big a difference that is, like let's say you've got a small business owner, let's say he does lawn care, and he's been expensing, he's been doing it the wrong way, and his income on paper is 25 grand a year, even though he makes 100 grand, right? Because he doesn't want to pay taxes, because nobody wants to pay taxes. So he can't afford to buy anything. But if he just goes back and changes all those lowers and things to a depreciation expense, all of a sudden he can buy the house. Now I know this works because I went through the exact same thing myself on my first purchase. I used to own a limo company. We made some money, but we had a lot of expenses we claimed, and so my income at the end of the year looked extremely low. I was quite good at managing my income tax liability, and so I couldn't go to buy a house. But luckily, this loan guy, he cared enough to sit down and explain this stuff about my taxes. He looked at my taxes and was like, well, you could buy this house, but you just have to start doing your taxes right. So he fixed it, I bought the house. So that's a hard-learned lesson that I'm not going to forget.